7, learning unit 7, and the last bit we covered 2 weeks ago was looking at that transfer. The rules are the rules, we just need to follow them, and you obviously have to be familiar with when you are allowed to transfer amounts and when you aren't. Right, the procedure is quite straightforward. You'll see obviously debits and credits apply. You'll have to increase the one account, decrease the other account, and you're obviously taking money from the client and you're putting it into the business bank account. Okay, remember you have two separate tier accounts, one for the trust bank and one for the business's bank account. What's probably more important here would be the requirements. So when can we actually transfer? Just to quickly go through this again, we did go through it previously, just to highlight some of the key words here. When looking at the client obviously needs to owe an amount to the business. So you cannot take money from the client's account if the client doesn't actually owe you anything. Right? That wouldn't be ethical. If the amount owing on his or her account exceeds the amount available, obviously you'd be limited to what's available. So if you are charging the client a fee of, let's say, 100, and in their trust bank account they've only got 80, you can't transfer more than what's available. Okay, that's logical. When the amount available in the client's trust creditors account exceeds the amount owing on his client account, obviously you'd be limited to the amount that's owing. So the opposite. If the client has 120 and you are going to be transferring 80, you can't take the full 120. You can only take what's due to your business. Okay, again, logical. Right, then the last few bullets here just look at 3 other considerations. The one here talks about a debit balance on his account and a credit balance on his trust creditors account. Okay, we know that a client will be a customer that owes the business, so you'd have a debit, okay, i.e. inverted commas debtors, and then you'll have a liability, which is the trust creditors account. Okay, the word creditor is there, so that's easy to remember. Liability meaning the business is owing the clients. It's the client's money. Then you've got 2 other options here. If the client's trust creditors account has a debit balance due to an error, okay, erroneous issue of the trust check instead of a business check, a transfer from the business account to the trust bank account must be done immediately. Obviously, errors need to be reversed and corrected. And then the last one is looking at this 10-day rule whereby you have to wait. If the client pays the attorney with the check, no payments can be made out of the trust bank account on behalf of the client within 10 days. Obviously, checks take time to clear. There's a 10-day waiting period that you need to obviously wait for before making any transfers from their account. Right, so that's purely theory. Then we looked at this table last week. The table actually gives you the structure, so you literally just need to follow the information in the question, and you need to look at, well, what does the client actually have? When you look at this table, you'll see you've got Mr. X, Y, and Z, and then you've got the total. Obviously, you are limited to the amount that you can transfer based on those rules. Okay, so what does the client have? What is the fees applicable, and so on and so on. So as long as you stick to this, and looking at that past paper just before we started, the past paper even gives you the format, you wouldn't really have to study this. Generally, if they didn't give you the format, then I would say you'd have to learn the format. Okay, you'd have to study these headings, and then you'd have to draw this up yourselves. But if they are going to give you templates like they did in the first semester, bonus. Okay, no need to study more. There's less to study, then just understand what you're doing, basically. Right, so here's an example. So let's see how that table works in relation to this example. Remember, we need to obviously highlight things that are important, and we need to look at what's ours and what's theirs. Okay, what's the client's and what's the business's. That's the key. When you do trust accounting, it doesn't matter what. These last 3 chapters look at all of that. What's the business, what's the client? And as soon as you can identify that, it's easy to post whatever you require to. Trial balance gives you opening balances. So if you had to do a T account, the T account would represent debits and credits. So depending on what you prefer, again, it's a personal choice because, again, looking at the past paper from last semester, you guys have two options, either the table or the tier counts, and because you can choose, you can actually decide on which you find easier. Personally, I like the tier counts better because we've been looking at workings where you've identified debits and credits. Again, you can decide. I'm not going to force you to do one or the other. You can decide which is easier for yourselves, and then you can follow that particular method. Okay, so if I draw up the tier accounts, we've obviously got balances here. All of these accounts will have their own tier accounts. Right, so the business bank accounts, there's a balance here, 9,150. If it's a positive bank balance, bank is an asset, and assets have debit balances. So there'll be a balance here. The trial balance is a list of debits and credits. No, the bank statement is the bank statement. The bank statement is the third party's record. Okay, so if the bank sends you a bank statement, then you apply the opposite, right? Because you're looking at their records. Okay, these are your records. They're your accounts. That's your bank account. That's your debit. The bank trust account, remember, one is the client's, one is yours. So you'll copy paste this and you'll label it the trust. Trust means the client's. Again, same things apply. Assets, you're just thinking about the client here because that's their money, not yours, but you account for it because the client gives it to you. You have two separate bank accounts, one for the clients and one for the business. 9450. Okay, the trust creditors control, just to revise, creditors means liability. That's easy. Credits, so trust creditors, and the balance will go there. Those two amounts added together should give you the same amount. Why? We spoke about this last week. Whatever the clients give you, you owe them. So the money sits in the bank and it sits as a liability, right? Because it's not yours. It doesn't belong to you. All right, if I add 5 plus 3 is 8, so 8,700 plus 7 is 9,450, so it is correct. I'm not going to show them separate, well actually I should because there are two separate clients. So let's put Nkosi and who's the other one? Modise. Okay, so yeah, let's keep them separate just because there are two separate clients. And 3750. 3750. There we go. Clients control. This you should view it as an asset. Think of it like debtors. Customers that owe you because you've rendered services. Okay, this would be your fees. Okay, Governor and Corsi and Modise again. So you're going to need more of these accounts. Okay, Governor. Corsi and Modise, and that's that. Okay, balance-wise, debit side, because these are assets. Okay, and that's why I'm saying maybe use the tier counts rather than the table. Again, it's personal choice. How familiar are you with those debits and credits? The more familiar you are with the basics, the easier this is going to be. Right, if you're not too familiar with this, then maybe just follow the templates. Just put in the balances as is. Okay, so 1770, 2550, and 2025. Done. Right, and that's actually quite an easy exercise as well, because they gave you a trial balance. You can see the debit, you can see the credit, so it's also simple. All right, capital. If I'm doing all the T accounts, I want to show all the T accounts. Whether they've got that in the example answer or not, it doesn't matter. Let's just do it ourselves. Capital. Capital will have a credit. Capital has 129. Okay, this is money that the owner would have given the business to start the business. Equipment, law library, so those are all assets. Assets have debit balances. Equipment will have 82,500. Okay, the law library, the sheriff, right, the law library has 27,000. The sheriff has a credit. What do you think this is? Remember, you have options. You have 6 options. It's a credit balance, so that eliminates the debit. So it can't be an asset, it can't be an expense, it can't be drawings. It's either capital or liability or income. Can a sheriff be income? No. Liability. Liability, it's a credit balance. An expense doesn't have a debit. Expenses have a debit. This isn't a debit. You can't say this is an expense. Okay, a sheriff as a credit represents a liability. So this is actually owing the sheriff. Okay, they help you do your work. Liability. Right, that's why it's important to know those rules, because the rules help you identify accounts. Stationery on hand. Okay, I don't think you actually did adjustments. So they've given you this where it actually doesn't come up in your module, which is unfair. It used to be in the module, and they used to talk about adjustments. This is an adjustment for stationery that you haven't used. So maybe just to add to your knowledge, stationery on hand. Because of the on hand says this is stationery, which is an expense that has not been used at year end. Okay, so that's just additional information relating to year end adjustments. That is an adjustment that the accountant would process. If you buy stationery on the last day of the year, you're definitely going to have stationery that you're going to need or use for the next year. So the stationery that you haven't used is considered an asset, but only an asset for 1 day, right, at year end. So that's the only reason why they've given you that. 4365. Right, then we need to look at additional information. The following totals appeared in the subsidiary journals of Naidu attorneys on the 30th of April. Right, so these are journals. Okay, what do we do with journals? We post them to the ledger, okay, to the T accounts. Instructions wise, required. Part A said you had to draw up the trust bank account, the business bank account, the client, the trust creditors, and the fees. Right, the fees we don't have here, we need to add it. So let's add a fees journal, not a fees journal, fees account, fees ledger. Fees would be what type of account? Income. Income has a credit balance. That's if they've given you a balance. There is no balance there, so we won't have an opening balance. Right, and the reason for that is income and expenses are closed off to capital, and that's a profit/loss calculation. Okay, that used to be in the module. It's not in the module any longer, so that you don't have to worry too much about, but that's something to consider here when looking at income. That's the reason why there isn't a balance. Okay, and then they either want you to complete the table or they want you to complete the T accounts. Okay, so I like the T accounts because it's easy to interpret debits and credits relating to your assets and liabilities, your rules. Right, so this is how you would do it. Trust cash receipts journal. Important, you would highlight this, the word trust, because now you know this is dealing with the client. As soon as I think client, I'm thinking trust bank and trust creditors. That's it. If I'm receiving money from the client, which is the client's money, does the client owe us more? No. Do we owe them more? Yes. Okay, so if you owe them more, what's going to happen to your liability? It's going to increase. So we need to go to our liability. We need to look at each of them. Okay, so we've got Stain. Okay, that's a new client. So in actual fact, you should create another trust creditor account for the other clients, for Stain. Stain, no balance for this client, 0. If I'm looking at the trust cash receipts journal, you can see Stain and Corsi are being affected here. Okay, Stain is a separate client. They would have their own separate trust creditors account. Their trust creditors account is seen as a liability, so you are going to owe them more because they've given you more money. That's going to go to the trust bank account. Right, you debit the trust bank account, you credit the trust creditors. Okay, debit the asset, credit the liability. Not too bad, right? Okay, we've looked at a lot of those workings. 15,000 goes here. If I highlight this credit, you're going to have a debit in the trust bank account. Okay, in the trust bank account, you can probably group these all as one. Why? Because this comes from the same journal. So you can just say total receipts if you want to. You can do it separately. Then you would show trust creditor Stain, and then you would show, who was the other one? Nkosi. Stain, trust creditor Stain, trust creditor Nkosi. Okay, so for Stain, 15,000. Okay, I highlighted the credit earlier. I'm going to highlight the debit now. See, there's the debit. Right, it has to balance. So when you do this, you do it debit and credit together. Okay, journal by journal, journal by journal, journal by journal, and then it's not too bad. Okay, so I've done that. I can cross it off or I can tick it. And Corsi has 3315. So 3315 is going to increase the bank. And I'm going to owe Nkosi more, so their liability is going to go up. The asset's going to go up, the liability is going to go up. So I debit the trust bank, there's it, and I credit the trust creditor. Make sense? Okay, 3315. Highlight those two figures. Right, so now I know I've done it correctly because I've got debits here, and I've got a credit there, and I've got a credit down here. There's it. Okay. Let's go back up. Let's go back to the journal. So complete, tick, cross out. Next, trust cash payments. Let's think logically. Who's paying? There's the key word. The client. It's a client expense. So again, I'm just thinking about two things, bank and trust creditors. That's all. Nkosi and Modise are paying. So what's going to happen to the money in the trust bank account? It's going to go down because they're paying, right? If you're paying and you're using client money, the client's money is going to decrease, right? Logical. Okay, so how do you decrease an asset? Yes, so let's show that. Who were they? Nkosi and Modise paid. So, Nkosi, Modise. No O there. Okay, and Modise. Okay. How much did they pay? 5805 and 1500. Right, that's it. See, it's so simple. All I did is I thought about my rule. What are they? And affect this T account. That's it. Okay, so now obviously I can't have credits without debits. So in trust creditor in Corsi's account, I'm going to show the debit, yes, for the bank. See that? Okay, there's the credit, there's the debit. I've got both, I'm good. Okay, I can move on. Trust creditor M, let's put that in. That's going to go here, bank. Right, there's the credit, there's the debit. Now I've done another journal. See that? Yes? It's not that bad. Okay, cross out, tick off. Happy with that. Next. Business cash payments. That should have stood out. It's the business's expenses. They didn't identify it. They just said it's sundry. Okay, so sundry means everything. Okay, it could have been stationery, wages, packing material, anything, whatever. Rent, doesn't matter. All of it is going to affect the bank. How? Let's think logically. If you're paying, what happens to the bank account? It decreases. How do you decrease bank if bank is an asset? Exactly. Alright, so all you have to do now is just record that there. Yes, because in the other accounts you would have written the bank, exactly. Right, sundries, CPJ. We actually should have put in that, the folio. Okay, CPJ, the trust. So I need to make these journals a little bit bigger, or ledgers a little bit bigger. This I would have put trust receipts. Trust receipts. And this I would have put trust payments. Okay, yeah, but we saw where those amounts came from. I just omitted that bit of detail, okay, the referencing. Right, but you guys can include that in yours. Right, sundry 8475, 8475, there's the sundry. Right, I don't have a T account for sundry, so I'm going to make one. Here at the bottom, sundries. I just want to show you everything so you can see all of it. Right, in sundry, I would have shown the other half of the account. Okay, so I can't record a credit without a debit. Right, so if you look at that, there's the sundry, right? Okay, in sundry, well, in bank, I recorded sundry. In sundries, I'm going to record bank. Okay, because what happens to the bank? The bank is decreasing, asset decrease. Right, if an asset decreases, the expense is going to go up. Right, so this credit is going to have a debit, which would be here, bank, business CPJ, and it would have been the same amount, 8475. Okay, and that would have been expense increase if you want to put the working in. Right, you don't have to show all these other accounts. I'm just showing it just as practice. Okay. Right, complete. Move on. Now we look at the fees journal. Right, fees refers to who? The client, but it's the client and the business. Okay, that's important because the fees are levied on the client's account by the business. Okay, what is the fees to your business? It's a form of income. Correct. So your income is going to be owed to you unless you received it. Here we can see that they've used client control, which is actually seen as a asset, meaning you're owed those fees. And then you've got these accounts, okay, Corsi and Modise, and then you've got the fees, okay, the income. Right, so let's show that. Let's go to the client control accounts. Did Governor get charged fees? No. Nkosi and Modise only. So Nkosi fees journal, fees journal, and the amounts 1890, 2.5. the one, there's the other. Those are debits, do you agree? Debits need credits. So we need to go down to the fees. Did we have a fees tier account? Let's see. Yes, we did. Okay, there's it. So here I'm going to record client control Nkosi and Modise, and those amounts again, 1890 and 2.5. Right, so now those debits we had earlier have credits. Those credits there are referenced with those debits there. Okay. Right, let's carry on. Tick that, cross that off. Next. The following entry was made in the general journal. General journal. Interest received. Okay, so interest was levied on the account that was in arrears. So Governor was owing you, and you've obviously charged them interest. Interest received, we don't have a tier account for it. We can create one. Interest received would be what type of account? Correct. Income would be credited, and you can even see it here. If they give you a general journal, that's a clue. Credit the interest, debit the client. So trust, credit, no, not trust, client control, Governor 225, and then in Governor's account, let's find that account, client control, there, client control Governor, you would have shown interest received 225. Okay, that debit now has a credit. There's the debit, go down to the bottom, there's the credit. I've recorded both. That's it. That's the end of the question. Yes. Okay, balancing should be easy. You guys have done it in the bank recon. Accounts that have things on both sides, i.e. the bank. This you'd have to balance. Balance carried down, balance brought down. This minus that, and the same thing here. Balance brought down, balance carried down. Sum up this side. Minus those two credits. Right, there's the balance. Okay, so for the business bank account and for the trust bank account, those are the balances. Right, just to add a level of detail here, do you agree this balance here on the trust bank account, what must that add up to? Yes, it needs to add up to all of the total as the trust creditors all added together. Okay, let's see if we've got that. So let's check. Here's the check. Right, equals trust creditor Nkosi. Ooh, I'm going to need a balance, so I'll get a balance here. Okay, I'm just going to put the balance on that line plus balance on this line plus, where's the other trust creditor? We had another guy, yeah, Modise here, plus that balance there. Okay. Okay, we'll need to put in amounts for them. Okay, so let's balance their account off. sum up all of this. This minus that. Balance carried down, balance brought down. Right, so there's the one balance. Okay, so there's the check. The check is tallying up what we're supposed to have. Okay, we're hoping that those two amounts add up. So there's the first client. Nkosi still has money with the law practice. Okay, just interpret the theory. This client has 3,210 still owed to the client that's sitting with the business. Okay, Modise, same thing applies here. Balance that account off. Right, so obviously that side's bigger. That minus this gives you a balance of 225. Right, so again, another client who still has money with the business. Okay, so now the balance has gone up to 5,460. Okay, we're getting close. Let's carry on. Where's the next client? Trust creditor Modise here. Let's balance it off. Where's the balancing? Let's get the balancing here. Copy. Okay, yeah, so this one has a balance of 3,750. Okay, this was the trust bank account. Oh, we still have other people. Stain. We need Stain as well. Where's Stain? Trust creditor, Stain. 15,000. Stain. Where's Stain? There's Stain. Okay, so let's copy paste the balance for him. There's Stain. Okay, balance carry down. It'll be 15. 15. 15. 15. Balance. Balance carried down, balance brought down would be the same total.
Yeah, but that's
The balance at the end, the end value. So 15, let's add 15 to this. Plus 15. What did I think I added too many.
Yeah, should be.
Let's see.
3210
3210. Yeah, that's one. Plus 2250 plus. No, you had Modise as well.
the trust.
Creditor Modise. Oh, I had two Modises. Sorry. Okay, I had two of them. Okay, we only have one client, and then the other one plus that one. Yeah, so there's two Modises. Duplication here. Okay, I'm wondering why it's not. Okay, there. Yeah, that works. Yeah, so here's my trust Nkosi. Here's my trust Modise. I had two trust Modises here. This one needs to go. Okay. Duplication. Delete. Okay, and that's it. Obviously, you could balance all the other accounts. And that's what they would have had in the answer. Should be. Is it the same? Let's check. 2460, that's good. The business bank account, 675, that's good. The client control. Okay, client control is everybody. Alright, they haven't separated all the different clients. Okay, I've chosen to show them separately. Client control Govender, so Govender's account, Nkosi's account, and Modise's account. Right, if I had to show all of them in one account, you would add up all the amounts. So just to balance these accounts off, okay, just to sum up, okay, you'll see it should be the same. The total there, and the total there. Right, so I've chosen to show separate accounts for all the different clients. You should do that actually, because now when a client calls you and they ask you how much in terms of fees do we owe you, what are you going to say? You're going to say, Mr. Governor, you owe us $1,995. Okay, you're not going to say, well, all my clients owe me $10,960. I don't know how much you owe me. Call me back in an hour and I'll tell you how much you owe me. Okay, you shouldn't group them all into one account. Okay, if they ask you for one account, then just put everything in one account. But you should show them separately. Okay, so those are the three clients. See, have a look. If I check, here's the check on the right here. Okay, Governor plus Nkosi plus Modise gives me 10,960. There's the 10,960. It's the total. Right, they've just shown all the clients together. That's what they've done. Right, it's better to show them separately because they're separate. Okay, the trust creditors control, okay, that's also the total. They added everything together. We showed them separate. Trust Modise, Trust Nkosi, Trust Stain. Okay, and when we added them all up, we had the same figure. So that was fine also. Okay. Right, that's the total. Same thing again. All of them together. Okay, and then they've given you the table. All right, the table is actually really basic because everything here describes what you need to do. Okay, so when you start the table, what do you need to start with? A balance. Okay, remember those balances that we posted through to either the debit side or the credit side? You'll see those are the exact same balances they've got here. It's just a different format, that's all. Right, so the 15,000 was our opening balance for Stain, for Nkosi, and for Modise. Right, if you go look at those three, let's look at Nkosi's account here. Where's Nkosi? Here's Nkosi. Okay, Nkosi's account. What's the balance? 3210. 3210. See? There's the balance. Modise, 2250. There's 2250. Balance. 15,000 was Stain's account. Where's Stain's account? Go down. There's Stain's account, 15,000. Okay, so just read the description. The description said here, trust creditors account balance before transfer. So before transfer means after you've processed all your journals. Okay, so it wasn't the opening balances, it was the closing balances. Okay, because that's what they said we needed to write in there. Okay, so if I read the description says opening balance plus trust receipts minus trust payments. Okay, so basically the closing balances. So those are the closing balances. Right, if I look at this, okay, how much do my clients have in their accounts? 20,460. Do you guys all agree? Okay. How much do the clients owe us in terms of fees? 10,960. Do you guys agree? Okay, we checked this. Okay, clients owe us 10,960. This client owes us 4,440. This client owes us 4,525. And that client owes us 19,995. Okay, so if I highlight those three amounts, those are the fees that those three clients owe the business. Okay, what did we read earlier? You can transfer money from the client's account to the business's account, so long as you meet all those requirements. Okay, remember those requirements that we read earlier? Okay, so have we met all those requirements? Yes. Right, am I limited to an amount? Yes, I'm limited to this amount. Do the clients have more in their accounts? Yes. If you look at the trust bank account, how much money is sitting in the trust bank account? 20,460. Can you transfer all of that to your business bank account? No, because you're limited by that. How much the clients actually have to pay you. Right, that's just the theory. We just read the theory. It's just practical example linking back to what we read. Right, so if you look at what they've done here, you would have seen they would have transferred the amounts that were limited to that. Okay, so Stain, did Stain owe us anything? No. Stain didn't owe us any fee, so Stain's account doesn't change. Stain's account is 15 at the beginning, it's 15 at the end. No transfer. Okay, you can't transfer, you're not allowed to. Nkosi, let's go back. Let's look at Nkosi's account. Let's see. Okay, there's Nkosi's account. Trust creditor Nkosi. Nkosi has how much money sitting with the business? 3,210. Do you agree? That's Nkosi's money with us as the business. Okay, that's why I say that's so much better showing it separate, because if you show it separate, you can actually see how much each person owes you, right? Okay, or how much you owe each person and how much each person owes you. Right, so let's just look at Nkosi. How much money does Nkosi still have with us? 3,210. How much fees are we charging Nkosi? 4,440. Do you see that? Okay, so limited to the amount he or she has. What was the limitation? Let's go up. 3210. 3210. 3210. Does that make sense? Okay, so the reason why I showed it separately is so I can calculate and see how much each client is either owing us in terms of fees or we owing them in terms of money that they still have with us. Does that make sense? Okay. So let's have a look at their working here. Okay, so what they've done is they've written the 3,210 there. Trust creditor account balance before fees. Okay, the fees charged, that was the fees charged to their account. Okay, they've seen the table personally is a lot more complicated because you've got a lot more other lines to fill in, and you just need to read these lines. Okay, so fees charged. I go to my workings. Where are the fees charged to Nkosi? There's the fees charged to Nkosi. See that one? Okay, I just write that figure in the table if I had to use the table. Okay, so I highlight that figure. There, now we have limited. So minus transfer of funds regarding fees to business bank account, limited to smallest of fees charged and trust creditors account balance. Okay, so because of this limitation, okay, we know that they have fees, how much? 1890, and we know that the balance was that, 4440, and it was limited to. So here they've limited to this, and then they've showed it separately again, which still gives you the same amount. Okay, strange way of disclosing it, but that's the way they want you to do it. So just follow the descriptions. Just read what they want you to do. Limited to the smallest of payments and trust creditors account balance. So smallest of the payments. Okay, so let's go to the payments. Where's the payments? Here's the payments. Nkosi. See, there's the payments. They said limited to smallest of payments and trust creditor account balance. Right, so their trust creditor account balance would now be 1320, so it's limited to that. Okay, I don't like the table. If you like the table, do the table. It's not going to matter. Okay, whatever you like. You have a choice. I just like T accounts because I just need to learn 6 rules and I just need to practice applying them. Okay, to me this seems a little bit more confusing. Okay, because you've got this extra level of detail, limited to this, limited to that, limited to all of this. Okay, it's limited to these balances here. Okay, so if you are using this table, you're doing it step by step. It's step 1, it's step 2, it's step 3, and then you get the final answer, which is the same as what we had originally. Alright, so yeah, you can decide on which you prefer. Oh, they even gave you Stain, see, good. Nkosi, good. Modise, good. Okay, yeah, very, very good study guide. See, all of that's there, so I don't even have to do it for you, it's there. Okay, but now at least you understand how they got to all of those things. And that's how you approach it. Okay, there's nothing new. It's all liability and assets, liability and assets, increase or decrease, increase or decrease, increase or decrease. Alright, the basics are so important, and that's why I've been stressing it. Get the basics right. If you get the basics right, you can deal with these things as and when you see them. Okay. Are we okay with that? Alright, perfect. There is another example that you guys can go through. If you have any questions, let me know next week. I'll answer any question you have relating to any of the workings here. Okay. I just want to try finish all the content. If there's more time, we can go through more of these. I just want to try get through all the theory that we need to. At least that's covered. And then we can practice as much as you want next week and the week after. Okay. With next week and the week after, I don't mind staying a little bit longer, an extra half an hour or so, if you guys need me to answer specific questions. Okay, so I'll cover the past paper in the 2.5 hours that we have, and then thereafter, if you guys have individual questions, you can come and ask me. Okay, I don't mind doing that for you. Alright, so that covers that section. There's the last bit. Well, second last bit. There's not much in the last 2 chapters. It's mainly theory, and it's quite law heavy because they talk about acts and they talk about sections. So that you'll probably have to study off by heart. So you'll know what interest and what investment account and when can you split it and when can't you split it.